Welcome to Phillip Mastermind. My name is Kim. Donald Trump has made a successful return to the presidential race in 2024, securing 312 electoral votes, well beyond the 270 required, and earning 50.2% of the popular vote. There are several key observations. Firstly, Donald Trump's Republican Party flipped 6 states to win the 2024 election. Also, swing states once again swayed the election results, where Kamala Harris underperformed in all of them. Another key demographic that swung the election result for Trump was his success with the Latino men, who previously voted in favor of the current sitting president Joe Biden in 2020. And finally, notably, the women voted for Harris, but by a smaller margin this round than they did for Democrats in previous election. CNN exit poll found that Harris won female voters' support by 10% over Trump. But in 2020, Biden won their support by 15%, and in 2016, Clinton did by 13%. This image illustrates the 2024 US presidential election map, highlighting battleground states needed for victory. Before the election, Democrats are projected to secure 226 electoral votes and need 44 more, while Republicans are expected to get 219, needing 51 to win. Trump's victory secures a clean sweep of all 7 battleground states, which together account for 93 electoral votes. These key swing states include Pennsylvania, Georgia, North Carolina, Michigan, Arizona, Wisconsin, and Nevada. On top of that, Trump also led Harris in all 7 swing states by a considerable margin. On US Senate results, the Republicans are poised to take the control of US Senate, marking a comeback for the party that has been out of majority since 2021. With 2 races yet to be decided, Republicans are guaranteed at least 52 seats in the chamber. The Democratic count included 2 independent senators who align with the party. Separately, if Republicans ultimately prevail in the House of Representatives, where they currently have 215 of the 218 required votes at the time of presentation, they will have control of all 3 cabinets of the country and be in the position to dictate the political agenda and help Trump to deliver on his promise to slash taxes and restrict immigration for at least the next 2 years until the 2026 midterm elections. With Trump's return for a second presidential term, investors should now shift their focus to how to strategically position themselves moving forward. There are several key policies proposed by Trump. Firstly, Trump's proposed tariff 60% on Chinese imports, 25 to 200% on Mexico, and 10 to 20% on other countries are aimed at protecting US industry. But this could lead to price inflation, reduced retailer profits, and trade retaliation. These measures may harm US exports and manufacturing competitiveness. One key concern is front-loading. To recall in 2018, when trade war first escalated, container rates surged for shipments to beat tariff deadlines. Secondly, Trump's approach to trade agreements often involves renegotiating existing deals to better favor the US, which can create uncertainty in the global markets. To note, in Asia, the US currently has bilateral trade agreements with Japan, South Korea, Singapore, and Malaysia. Thirdly, on taxation, the proposed tax cuts primarily benefit high-income households and businesses, with corporate tax rates potentially reduced to 20% and 15% for domestic manufacturers. While these cuts are expected to stimulate consumer spending, these cuts could also widen deficit, posing fiscal risks. Number 4, Trump has also advocated for increased infrastructure spending, which could stimulate economic growth and create jobs. Number 5, the proposed stricter immigration policies, including mass deportations and reduced legal immigration, could also lead to a shortage of workers in industries such as agriculture and hospitality. As foreign workers have been key to job growth, a tighter labor supply may drive wages and inflation, potentially hindering the long-term productivity. And finally, on geopolitics, Trump's foreign policy could shift with a focus on Ukraine and the Middle East. He plans to reduce military aid to Ukraine to push for a negotiated settlement, while his approach to the Middle East remains unclear. But that might include pressuring Israel to concentrate more on countering Iran. So, what are the impacts? For the US, with Republicans controlling both houses of Congress, there's a potential for legislative action to move forward in late October. Elon Musk suggested that he could reduce US federal government spending by $2 trillion under the Trump administration. And fresh from the oven, Trump had elected Elon Musk to lead a new government efficiency commission under the Department of Government Efficiency. This is a key area to watch, especially if Donald Trump aggressively pursues this policy, as it would likely involve significant cuts to entitlement programs. Separately, corporate tax rate cuts are also expected to boost earnings, which could help to support the market. For China, implementation of the potential tariff hikes under the new Trump administration have negative impact on the Chinese economy in 2025. The net impact ultimately depends on China's policy response. However, a bright spot is that valuations in China have already factored in many negative news, and investors' positioning in Chinese equities has been relatively light. And for Taiwan, Trump has said Taiwan should pay the US for protection from China. Trump also repeated accusations that Taiwan had taken almost 100% of the US semiconductor industry. Trump, being a businessman, will likely take this opportunity to renegotiate trade agreements with Taiwan to protect the interests of Americans. On FX, a second Trump term will likely enhance US dollar strength, as the Fed is expected to respond cautiously, limiting rate cuts due to fiscal expansion Trump will likely pursue. With national debt anticipated to rise by over $7.75 trillion by 2035, pressure for higher US term premium would likely push the dollar index up. Regional currencies will be under pressure. On rates, under Trump, increased US borrowing could elevate US Treasury yields, putting upward pressure on global rates and including MGS yield. The widening US fiscal deficit may trigger inflation, further raising yields in both the US and Malaysia. This could increase capital outflows, stressing MGS yields. Additionally, if the Fed adopts a cautious stance and leans toward tighter monetary policy, it may limit favorable yield spreads for emerging markets like Malaysia, further compounding pressures on the bond market. Finally, for Malaysia, based on the past experience, Malaysia stands to benefit from the intensification of the US-China trade war. In fact, following the first trade war, re-exports have grown significantly, accounting for 22.1% of Malaysia's total exports in 2023, up from 18.6% in 2019. FDI also surged, rising from 21.6 billion ringgit in 2016 to 128.4 billion ringgit in 2023. Key sectors attracting FDI include electrical and electronics, semiconductors, green technology, machinery, and medical device. Finally, Malaysia's strategic location and improving infrastructure are also key factors in this trend. In conclusion, as Trump returns for the second term, investors would need to embrace volatility, recognizing that his policies may introduce uncertainty but also potential opportunities for growth. We maintain a cautiously optimistic outlook on the US market, as corporate earnings remain resilient alongside positive economic data. Additionally, Trump's proposal to reduce the corporate tax rate to 15% could enhance companies' earnings prospects. Export-driven economies like China, Taiwan, Korea, Japan, and Mexico may face heightened competition from the US. However, the full impact is likely to be felt over the long term, as companies may find it difficult to quickly source for cheaper alternatives in the short term. On the other hand, Australian and Indian companies with significant US operations may benefit from the lower tax rate. Malaysia, as previously mentioned before, will continue to benefit from trade diversion. A noteworthy avenue for investors seeking diversification in their portfolio is through Phillip Capital Malaysia. Phillip Capital Malaysia offers multiple private managed account services managed by professional fund managers. By leveraging on Phillip Capital Malaysia's private managed services, investors can enhance their resiliency, optimize portfolio performance, and navigate the complexities of the market with confidence. Apart from our inaugural private managed account services, we also offer unit trust funds, PGWA, that could cater to different investor needs. That's all for today. Stay tuned for our next Phillip Mastermind. This update is brought to you by Phillip Capital, your partner in finance.